In this video, we're going to talk a little bit about support and resistance and how it makes up trends. Trend lines are basically angled lines of support and resistance that identify a trend in a market. It can either be an uptrend or a downtrend. And trends and identification of trends is extremely important when trading. A lot of the people like to say the old adage, the trend is your friend. People like to trade with the trend because it has a higher chance of probability than trading against the trend. And once a trend is established, trades that are taken with the trend have a higher probability of success over a long period of time. So it's very important to know how to identify a trend and how to use support and resistance lines to guide you in your trend trading. So what you see here is a basic breakdown of support and resistance and how it can build a trend. You'll see that the dotted horizontal lines are lines of resistance and support as described in the previous video. You'll see that we have a line of resistance on every peak and a line of support on every valley. And this is basically indicating where the trend reverses and what the trend channel or the trend lines will look like in supporting the trend. Once you use support and resistance to establish a trend, you can then begin to trade within the trend on different types of movements that some might refer to as thrust and reaction. The thrust part of a trend is basically the movement from support to a level of resistance, and this is pushing up in the direction of the trend, basically continuing the trend. Reaction is what happens whenever the price comes back off of resistance and heads back down to support on the other side of the trend channel. So basically it's a reactive force on the upwards movement of a trend. See, the market, no matter what time frame you use, no matter how you look at it, always moves in waves. There's really no one specific direction that a market can move for an extended period of time. There has to be times where standard cases of supply and demand come in and actually causes the market to pull back a little bit between thrusts, if you will, and that's called the reaction. Whenever we're identifying our levels of support and resistance, you'll see that they start to follow a certain upwards pattern or a downwards pattern, and this is known as just simply identifying the trend. Trend lines play a very important role in identifying a trend because once they're established and drawn between levels of resistance and levels of support, then we have some pretty unique and interesting trading opportunities that come from that. You could either trade on the breaking of trend lines, which basically show a reversal of a trend, and we'll get into that here shortly, or you can trade off of the reaction whenever it comes down and touches support and trade the thrust moving back up in the direction of the trend. And this is a more common practice, is once again trading with the trend is a very important topic whenever you're doing trend trading overall, because trading with an established trend could possibly yield a higher result. And it's technically a much safer thing to do. It's very difficult to pick exactly when a trend's going to be reversing and breaking out of its established trend lines. So I don't want to say it's almost a guess as to whether or not you're going to be trading in the opposite direction, but it's easier to trade with an established trend than it is to trade otherwise. You'll see there are two different types of trends. There's uptrend and there's downtrend. Okay, uptrend is basically defined as rising levels of resistance. Basically, whenever the market comes up and pulls back from a level, you draw a line of resistance. And if these levels of resistance are rising, then it's a standard uptrend, and it should be defined as such. Levels of support need to be rising, not always at the same level as the levels of resistance, but they need to be rising with it at basically a certain type of slope, which gives you the direction of your trend, either up or down. Now, the market can move sideways for a period of time, and that's where the previous video about support resistance really comes in, where you can box in prices. This technically isn't necessarily a trend. It's more of a sideways movement of indecisive, market action, if you will. So since we're already able to define sideways market and box in price with resistance and support, let's take a look at a couple of applications where we can use our knowledge of resistance and support to draw sloping lines of resistance and support that encompass a trend and let us know what direction the market is heading and how we can actually use this to plan and place our trades. Now here's a really good real-world example of a falling trend, and this is how we were able to establish this trend, and here's what we can do to actually trade with this. So in our previous video we discussed how to draw levels of support and resistance. For example, we have the price on the euro US dollar, we have the price come down and pull back, and once it pulls back to a degree that we know that it's a level of resist or support, excuse me, we can actually draw our line of support here. And let's ignore these red lines for the time being. Once the market continues up and pulls back down, and in the same fashion, then we can go ahead and draw our line of resistance. Okay. Now by doing this, let me try to make the hard right edge here. By doing this, we actually create the box that we had in our last video, basically defining two levels of support and resistance. Now see, a trend is defined as, if you remember, support and resistance levels that are consistent, but they're going in one direction. They're rising or falling. Okay. So as soon as we move forward and this line of support is tested, we come down and we create another point here at the bottom. Once there's 2 points, then we can begin to draw a trend line. And a trend line is really nothing more than a level of resistance or support that goes in the direction of the trend. What we're doing is defining what the trend is currently. Okay. So as this continues to move down and we continue to create these new points, which would be levels of support here, it's becoming very apparent that we have levels of support, but they're all descending. So at this point, we can go ahead and connect these points, and we can see that we have a definite downwards trend. At the same time, we have the same thing happening on the levels up here. So since we have our defining point and our secondary point begins to emerge, we can see that we've got a definite trend going in the down direction. And once this is established, then we can begin to look for trading opportunities within this downwards trend. One of the obvious ways that people really like to trade trend lines, declining or increasing trend lines, is to look for the trend reversal. And what this means is that no matter which instrument it is, and no matter what currency pair it is, you have an extremely high probability that, unless something outlandish happens, that a trend eventually will reverse and begin to go the other direction. That's noted by defined breakouts of either the resistance trend line, which is resisting price, or the support trend line, which is supporting price. Well, in a downwards trend, you're not really looking for levels of support to be broken. That would just signal a stronger downtrend, and you basically wouldn't be trading with the trend at that point. You would be betting that the trend would increase or strengthen. Well, once this channel is defined, once the trend line channels are defined, the longer they go, the more likely it becomes that breaking to the upside will yield a stronger trade opportunity than breaking to the downside. This level of support is basically here to support a downwards trend. So as the price is moving back and forth between these two trend lines, we see we have a definite downtrend. Breaking to the upside is a very strong way to it's basically trading the trend reversal. So if you remember to our last video when we talked about levels of support and resistance and how levels of support could become resistance and resistance support, the same thing holds with trend lines, because remember, trend lines are really nothing more than levels of support and resistance that defines what direction the market is heading. It doesn't necessarily provide horizontal levels of breakout, but it defines the direction that the market is heading. So the market breaking this trend line here, you'll see, as we talked about in the last video, it actually becomes a level of support. It comes back down, touches this level of support, and continues in the direction of the break. Because remember, in order to reverse a trend or to break one of these trend lines in a very defined way, something has to happen. Some fundamental force, such as a news release or a change in the market behavior, supply and demand shifts. Either one of these things or all these things have to happen in order for a trend to be broken. So one very good way that traders like to use trend lines is to define the trend and then watch for a break. And you should always remember that because the market moves in waves and because this line is so defined, that when breaking above or breaking below a trend line, it usually becomes a level of support again, just like it did here, where we broke out, it comes back and creates another level from the same trend line, the same defined trend line. It creates another level here, and the market moving in waves will continue in the direction of the break more than likely. Now, usually, whenever markets decide in which direction they're going to go, we still have that same thrust and reaction movement that we see here. We still have the same thrust and reaction movement, but if we turn and it begins to go in the other direction, it's important to note that this thrust and reaction it begins to go in the direction of the newly defined trend. So for example, when we break this line of resistance here, come back down and become support, we begin to create a new line of resistance and support defining the trend going upwards. And one could actually go back and forth with their trend lines this way. And you could technically trade on the break of the trend lines each time. But notice again, when these trend lines are broken, it also becomes a level of support and then continues in the other direction. So once you get a feel for how the market moves and you can define how the market moves by drawing these trend lines, then it becomes easier to pick out points where you should be able to pick up a few extra pips or ride the trend the whole way until it breaks in the other direction. Now, a very strong way, other than trading the breakdown of trends, is to actually trade within the trend. So once we use our levels of support and resistance to define our trend lines and define which direction that the market is moving, we'll want to look for places where the trend will continue to go in that direction. So I usually don't like to draw trend lines until it's at least defined by 2 points. And just as lines of support and resistance get stronger as the market touches and fails to break this line, the same exact thing happens with these angled trend lines. So as we have a defining point up here in the top left, and as the market hits and defines more points that line up with said defining point, we have opportunities that allow us to trade on the pullback from this trend line, but always try to do it in the direction of the trend. Because once again, trading in the direction of the trend yields a higher probability in most cases than trying to trade against the trend. So once you define a trend, just like this, once it touches a couple of times and you have a trend that's well defined, you always want to try to trade in the direction of the trend. So trading on pullbacks from so we have like an uptrend here. Trading on the pullbacks from the top of the trend is a little more risky than trading the bounces off the bottom of the trend, because if you trade off of the bounce from the bottom of the trend and it's going up in the direction that you drawing your trend lines, that gives you a pretty defined entry method for trading with the trend and trading within the trend channels. Now, if you'd like to try to keep with the theme of trading with the trend, a really good way, especially on longer term trends and wider trend channels, is to actually draw micro trends or smaller trends within the trend channel. This gives you a breakout point. It gives you an area that you're looking to trade, but it still keeps with the original overall prevailing trend. For example, so we have a defined trend line up, and we're looking to trade with the trend, okay? But how exactly do we know where we would want to get in based on the direction of the trend? So the key with this type of strategy would be to trade shorter term trends within longer term trends, but always trade in the same direction. Now here's a quick example. So we have our pound US dollar, and we're actually at this point, since our trend is defined, able to draw trend lines down. So let's say you're in an uptrend and you always want to break a trend line in the direction of the overall trend, which is up. So you're always going to be drawing lines of resistance at this point. Okay, see, if I were to draw this line of resistance here, which is this red line, and it's a point that's been hit 3 times, so it's actually a pretty solid line of resistance. You can see that at this point in time, the trend is actually broken, okay? And we are heading in the direction of the overall trend, which we defined with our 2 lines here. And that gives us a nice solid trade where the target would be the top of our trend line. We're looking to ride that thrust movement up to the top, and then we're looking to exit based off of the natural movement of the thrust and reaction, which is the pullback. So now that we've got our second defined point up here, we would be looking to exit this particular trend following trade near the top, and that gives us a pretty substantial move. You know, in this case, we're on a 4-hour chart, so it's a longer time period. That would give us about 380 pips or so, targeting the top of the trend. And we would be looking to repeat this process as many times as possible until this trend decays. So once again, the natural movement of thrust and reaction is what we're looking to put in our pocket, essentially. So once we determine what a good solid trend line should be based on our identification of resistance and support, we should be able to draw trend lines within our trend lines, basically smaller term trend lines that aid us in getting in and getting out of the market, still in the direction of our prevailing trend, but it gives us an entry point. And our exit point obviously would be either the top or the bottom of the trend, depending on which direction we're going. Once again, you want to always try to trade in the direction of the trend, and you want to kind of get it as defined as possible. You want to kind of define this movement back towards the bottom part. So like this isn't very well a defined movement. It actually breaks relatively early. And once again, here's a really good example of how resistance becomes support. You know, bounces off the support, but none of this holds. This doesn't hold very well at all. We want to find something like this where it's fairly well defined, gives us a nice 3-touch trend line within a trend, and gives us a nice entry point, this area around here, which gives us a jumping off point, and our aim would be somewhere near the top of the trend line. To be able to use these lines to define and kind of predict what the market's going to do and where it's going to turn can be beneficial to almost every trading system. Even if you're getting a signal on a trading system that you might be using that has nothing to do with trend lines whatsoever, to be able to notice these prevailing trend lines and to be able to understand that they are very significant in most cases. Even if you're given like a sell signal from one of your trading systems around this area here, you know that since you're near the bottom of your trend line, we've already pushed down quite a bit. You've even got a situation where you can, where you can begin to draw yet another trend line inside of it. The market would just be pushing down too much. In this case, it would just be very good to be able to locate these little micro trends inside of this larger trend to even help you filter out your trades no matter what trading system you're using. So trend lines are a very simple tool to use. They're extremely effective, and they're, as a technical analysis tool, they're second to none. You're basically just connecting dots on the chart, and the dots that you're connecting are nothing more than the horizontal support and resistance lines that we learned about in the last video. But hopefully this kind of helps you understand trend trading just a little more and helps you take your idea of trends, trend line drawings, and what you can do with them to another level. Remember that the more a trend line is tested or touched without being broken, the more valid that trend line is, the stronger it is, and the more likely that it's going to hold up as the market moves forward. And above all, it's important to remember that trading with the trend, even if you choose to trade on trend line breaks such as this, trading with the trend is a very, very good thing to do if you intend on using these trend lines for that purpose.